¿Qué pasa, amigos míos? What's up, my friends? I'm Russ. This is Dapper Dividends. You know what? I want to level with you. I'm an average, ordinary person just like you. I never went to college. I work in the trades. I'm a welder, a service technician, an installer. Today I worked at a company called Nation Pizza in Schaumburg, Illinois. They make pizza for Walmart. Really cool place. I call them the Pizza Palace. But the point is, from the time I leave the house till the time I get home, I'm listening to podcasts all day long, all different kinds of podcasts. I hear some of the most fascinating, informative, and interesting conversations. I'm going to start sharing them with you, giving you quick thoughts. When I hear something really interesting, I'm going to let you know the podcast and who said it, such as today's with Matt Caruso. He was on the Investors Business Daily podcast. You can follow him on Twitter at TraderMCaruso. And check out the Investors Business Daily podcast. Really cool. You can go to investors.com/podcast if you want to hear the entire episode. So here's my quick 1-minute rundown, and I'm going to end it with 4 stock picks that he gave. So Mr. Caruso does say that it's much harder for algos to affect long-term stock prices, meaning that the computers, they trade the charts and the patterns really quickly, blowing in and out of trades on a daily basis. But over the long term, it's going to be much harder for them to affect the price of stocks. Every strategy has a time where you probably shouldn't be using it. That's a very fascinating thought. But for me as a dividend growth investor, I'm going to keep using it because when prices are high, I will buy less. But when prices are low, I will buy more and get more bang for my buck. 3, the better you understand the business, the more confidence you'll have through bad times and be less likely to miss buying opportunities. I love this one because I just talked about it. If you try to copy Warren Buffett's portfolio, he's going to have different convictions because he did different research or his team did different research that you will not have. So always do your own due diligence and make sure that you understand the business. And when times get tough, and the price drops, you're going to want to buy more if you're familiar with that business. 4, the best place to find a gold mine is next to a gold mine. This is almost self-explanatory. If a company is blowing up and doing good, if you see an Amazon, look for other companies that are in the space or could be affected by the gold mine because you're probably going to find gold. The market will always find a way to confound you. Be strict and rigid in following your rules and your confidence. This is something that worked out beautifully for me, I can attest to, because when the market crashed in March of 2020, people were freaking out. People were panicking. I wasn't panicking. I was buying more. I couldn't believe the prices. I was ecstatic. I had people that I worked with saying like, aren't you freaking out about the market? I said, yes, I can't buy I don't have enough money. I can't buy all these, I can't buy any more McDonald's, Johnson & Johnson, 3M, Starbucks, Procter & Gamble. I've run out of money. They're too cheap. I've spent all my money. So I can attest to that. This is perfect. This is how I know that my system works for me. And then the 4 stock ideas that they shared and they briefly touched on were number 1, Shift4 Payments, ticker FOUR, is a recent IPO. 3 of these are recent IPOs. Number 2, SelectQuote, ticker SLQT. Number 3, Denbury Resources, ticker DEN. And number 4, Revolve Group, ticker RVLV. Keep in mind, these are stock ideas. I'm not going to get into them other than to just give you these 4 tickers and say, do your own research and due diligence. Listen to the podcast. They'll talk about them and see if these companies might be right for you. And now, the main event. We've got Johnson & Johnson and Pfizer. Gonna go toe-to-toe. I'm going to see which of these is the better buy. Let's get into it. They're both in the pharmaceutical sector, but Johnson & Johnson has so many products throughout so many stores and hospitals. I love Johnson & Johnson more. I ruined it. I like them more, but let's get into it and see if Pfizer is a better buy. So Johnson & Johnson today is at $164.93 and Pfizer is at $36.25. Price to earnings ratio. This is basically what you are paying for every $1 of earnings. They're very close. Johnson & Johnson at 29.5 and Pfizer at 28.8, but Pfizer is a little bit cheaper, so Pfizer gets the nod. Price to earnings doesn't tell us anything about the growth, so there's the price to earnings growth ratio. Currently, Johnson & Johnson's at 2 and Pfizer's at 2.1. A good metric that people like to look for is about 1 or lower to see if a company's undervalued. So this one is completely a wash. Price to book ratio next. So all that the book value is in this metric, the book value is the total tangible assets minus the liabilities divided by the share price. We get a ratio. Johnson & Johnson is 6.9. Pfizer's at 3.2. So Pfizer gets the nod there. But what a lot of value investors that I've read look for is 3 or lower. The lower, the better. It could mean a company's undervalued, but something under 1 could mean a company is in trouble. But a sky-high price to book ratio necessarily could just mean that there's a lot of confidence in the company, such as Amazon had sky-high price to book ratio. So not necessarily a bad thing, but we'll just go with the traditional metric here and give the nod to Pfizer yet again. Future growth is pretty close, 14.7 for Johnson & Johnson, 14% for Pfizer. This is, again, on analyst estimates. You go to different websites. This could be all over the place. So we're basically going to call it a wash, but still both very nice. Quick ratio is next. It's a really simple metric. All that we're going to do is subtract the short-term assets from the short-term liabilities, and that will give us our quick ratio number. You want something that's over 1. And right now, Johnson & Johnson is at 1.21, and Pfizer is at 1.35. 1.35. Pfizer gets the nod, but they're both very good, very liquid. But going by this ratio, this metric, Pfizer is just a little bit more liquid. The dividend yield, very important for someone like me that's a dividend growth investor and investing for passive income. Johnson & Johnson at 2.45% yield. Pfizer at 4.30%. So Pfizer way above Johnson & Johnson on this one. Checking out the dividend streak, Johnson & Johnson about to hit 59 years of dividend increases, while Pfizer's at a very respectable 11. Quick peek at the payout ratio to shareholders. Johnson & Johnson looks like it's at 71%, and Pfizer looks like it's at 121%, which is no bueno, meaning they're paying out way more of their earnings as a dividend. But this is not the case. These earnings per share numbers are accounting numbers. They can be manipulated and massaged by accountants. So I always like to look at the free cash flow. So when we look at the free cash flow here, as I went on Yahoo Finance, you go to the cash flow statement, and what you want to do is divide the dividends paid by the free cash flow. And when we do that, we see Johnson & Johnson is only at 51.91%, which is very healthy and gives me the warm fuzzy for J&J. But remember that 121% now becomes 72.68% for Pfizer. So that's very manageable. That's a lot of dividend investors like to look for 70% or under. So that's really close. They should be fine paying that dividend, but always check the free cash flow number down to the nitty gritty. I love this number. If you've been watching my channel for any amount of time, you know I am such a big believer in the interest coverage ratio. All that this is you're taking the operating income divided by the interest expense and you get a number. It tells you how easily a company can pay the interest on the debt. First up, because J&J is one of my favorites, Pfizer is currently at 6.04. In other words, they have $6.04 of operating income to pay every $1 of interest expense. Value investors like to look for numbers of 5 and above in the Benjamin Graham school. And now we go to J&J. Oh, 99.07. J&J has $99, 99 problems, and an interest coverage ratio ain't one. $99 for every $1 of interest expense. This is one of the best numbers I've seen. They blow that out of the water. They can easily cover the interest on the debt. So just hands down, J&J is my favorite ICR number, probably of any stock I've looked at. And the valuation, which everybody loves, simply Wall Street's, but a lot of people don't understand it. It's a discounted cash flow model. They're basically looking about 10 years into the future and expecting that to be the share price and then discounting that back to a price today, which we get at $252.54 for Johnson & Johnson, making them about 34.7% undervalued, and $80.94 for Pfizer, making them about 55.2% undervalued. Again, the way I like to think of this as this is basically what they expect the share price to be in about 10 years. So take that with a grain of salt. It's just best guessing. We don't know what's going to happen in the future. There you have it. Pfizer actually took this little toe-to-toe, knockdown, drag-out fight 5-3. But I will wrap it up and say that for the short term, Pfizer is the much more attractive company. They may do better in the short term just going on share price alone. But for myself, I am a dividend growth investor and I am investing for passive income. So I love Johnson & Johnson. I will go with Johnson & Johnson for the long term. Pfizer, I may buy a little bit if it dips a little more, but J&J, I love J&J, and that dividend is safe and solid, and they are going to keep growing that for many, many years. No problems there. If I've helped you out in any way, shape, or form, please help me out with a like and gently tapping the subscribe button. I would appreciate that. Follow me on Twitter at RustyRam78. Check me out on Instagram at Dapper Dividends. And please, expertise comes from the community. I'm just an average, ordinary person like you. I'm not perfect. I'm always learning. So if I've missed something, let me know. Let us know. Let's start a conversation. Leave a comment in the comment section below because you know where the comments go. Thank you for checking my channel out. And I will talk to you in the next video.